Hello, I'm Dr. Ilyas Iskender. Today I'll be sharing with you the historic transformation and critical developments in global commodity markets as of December 2025. Silver, historic breakout and new supercycle. As of the end of 2025, silver prices broke through the $60 per ounce level, achieving a historic breakthrough. In fact, according to current data, silver has risen to $64 and continues to set records. But this isn't just a speculative move, this is the beginning of a new supercycle triggered by deep supply shortages in the physical market, critical depletion in London and New York stocks, and China's use of silver as a strategic weapon. What's particularly striking is this. In November 2025, the United States Geological Survey officially added silver to the critical minerals list for the first time. This confirmed that silver is no longer just an investment metal, but an irreplaceable national asset for energy independence, military technologies, and digital infrastructure. China retaliated by imposing strict state licensing and quota requirements on silver, antimony, and tungsten exports in October 2025. This move by China, which controls 90% of global silver processing capacity, shows that the metal wars between the US and China have reached a new dimension. Byproduct economics, silver's hidden trap. Now let's get to a fact that most people don't know but is perhaps the most critical. Silver is not actually a silver mine product. 72% of global silver supply is obtained as a byproduct of copper, lead, zinc, and gold mines. What does this mean? It's simple. Even if silver prices reach $100, if the global economy enters a recession and copper demand falls, copper mines will cut production. In this case, no matter how high the silver price is, more silver cannot enter the market. This is called inelastic supply in economic theory and creates a terrifying scenario. Supply decreasing while prices are rising. For example, Chile's Escondida mine is the world's largest copper mine. Silver accounts for less than 1% of revenue at this mine, but it produces massive amounts of silver. If this mine goes on strike or copper demand falls, production will decrease regardless of the silver price. Technological demand. Shock, solar, robots, and electric vehicles. When it comes to the demand side, we encounter incredible numbers. Solar energy revolution. The solar panel industry is transitioning from old PERC technology to next generation technologies like TOPCon and HJT. These technologies consume 50% more silver. By 2030, if the 1 terawatt solar energy installation target is reached, this sector alone will demand 14,000 tons of silver annually. That's equivalent to half of global mine production. Humanoid robots. 2025 was the year when humanoid robots ceased to be science fiction and became real commercial products. Companies like Tesla Optimus and Figure AI are in production. Goldman Sachs forecasts 1.4 million units by 2035. Morgan Stanley predicts 1 billion robot stock by 2050. Elon Musk talks about an annual production capacity of 100 million post-2040. Each humanoid robot consumes 20 to 50 grams of silver. If 100 million robots are produced annually, this means an additional 2 to 5,000 tons of silver demand just for the robotics sector. Electric vehicles, silver usage, which is 20 grams in internal combustion vehicles, increases to 50 grams in electric vehicles and exceeds 60 grams in autonomous vehicles. And here's an important point. The cost of 50 grams of silver used in a $50,000 vehicle is only $160, even if silver is at $100. This is 0.3% of the total cost. Therefore, automotive giants will not stop purchasing no matter how much silver prices rise. Supply-demand deficit and price projections. The silver market has closed its fifth consecutive year in deficit as of 2025. The deep stress in the physical market is very clear. More than 30% decline in LBMA stocks. Deliverable metal on COMEX down 70% from its 2016 peak. I've modeled 3 scenarios for the future of silver prices. In the conservative scenario, I expect $55 to $60 in 2030 and $60 in 2035. In the base scenario, with a 50% probability, I forecast $85 to $95 in 2030 and $110 to $120 in 2035. In the aggressive scenario, with major copper mine strikes in Chile or Peru, a robotics explosion, and China completely halting exports, we could see $150 to $200 in 2030 and over $250 in 2035. Oil market, geopolitical risk and supply surplus paradox. There's an interesting situation in oil markets. On one hand, there are serious risks like US intervention in Venezuela and Ukraine's attacks on Russian refineries. The US is seizing oil tankers off Venezuela. Most ships cannot leave port. Ukraine is hitting Russian oil facilities. About 120,000 barrels of daily production has stopped. But the market doesn't care about these risks. Why? Because the IEA forecasts a record supply surplus for 2026. Brent oil prices are hovering just above $60 in a fragile balance. There's a very important development here. ExxonMobil has reduced supply costs in the Permian Basin to $30 per barrel using AI-assisted drilling techniques. What does this mean? Even if oil prices stay at $60, Exxon will make huge profits. By 2030, Permian production is expected to reach 2.5 million barrels of oil equivalent per day, twice the 2024 level. Metal markets, geopolitical competition and supply chain wars. After the Fed rate cut, gold reached $4,200. But what's really striking is silver's divergence from gold. Physical demand from the solar panel and artificial intelligence industries separated silver from gold and pushed it to $64. In the copper market, there are interesting developments. The expectation that the US will announce import tariffs coming into effect in 2027 in mid-2026 is causing copper to flow into the US. This creates an artificial perception of supply tightness outside the US, but the reality is global visible stocks have increased 40% compared to last year. So even though prices are breaking records, Chinese demand is falling and there's regional imbalance rather than a real shortage in the physical market. However, copper suffered a sharp 3.5% correction due to AI sector bubble concerns. The connection between copper and tech companies has become clear here. In the steel market, the China factor is at play. China's real estate sector crisis has collapsed domestic demand, but production capacity hasn't decreased at the same rate. Result? Chinese producers are exporting massive amounts of steel to world markets at a loss. In the first 11 months of 2025, China's steel exports reached 107.72 million tons. Annual exports are expected to reach 117 million tons, breaking the 2015 record. This situation is putting global steel producers in a very difficult position. German industrial giant ThyssenKrupp expects a net loss of up to 800 million euros in fiscal year 2026 due to Asian competition. On the other hand, Japan's largest steel producer, Nippon Steel, is pursuing aggressive growth. After acquiring US Steel, they aim to increase production to 100 million tons in the 2030s. An interesting detail, China is introducing licensing requirements for approximately 300 steel products starting January 1st, 2026. This move gives the Chinese government the ability to directly intervene in supply-demand balance. In the aluminum market, green energy demand is colliding with supply constraints. China has an annual production cap of 45 million tons, and this has pushed LME aluminum prices up to $2,920 per ton. Critical minerals, the era of mineral nationalism. The Pentagon has taken a revolutionary step for antimony, which is vital for ammunition production. For antimony, whose supply is almost entirely controlled by China, it has designed a portable strategic micro-refinery network consisting of 4 containers. This project was implemented entirely with national security priorities without regard to economic profitability. This is the clearest indication that the US is adopting state capitalism methods to break its dependence on China for critical minerals. In the cobalt market, the Democratic Republic of Congo, which controls more than 70% of world production, has introduced export quotas to push prices up. This supply shock has pushed cobalt prices up 140% from their February lows. Agriculture and industrial raw materials. In agricultural markets, China's massive import appetite is decisive. In November, China's soybean imports increased 13.43% compared to the previous year, reaching 8.11 million tons. Total imports for all of 2025 are expected to exceed 110 million tons, breaking all-time records. In industrial agriculture, China is aggressively increasing its pulp production capacity to establish global dominance in the paper and packaging sector. Between the last quarter of 2025 and the end of 2027, 5.5 million tons of new capacity will come online. 2026. Outlook. Fragile balances. As of December 2025, global commodity markets present a complex picture where old and new economic dynamics are intertwined. On the energy side, production strategies with $30 per barrel costs by companies like Exxon and Shell provide high profitability even if prices stay at $60. The solar energy revolution in Texas has proven that renewable energy can now gain market share without needing subsidies. On the metal side, Records in gold and silver are a pricing of distrust in the global financial system. Silver's industrial and strategic role may make it more attractive than gold. The Pentagon's antimony refinery move announces that the free trade era is over and the era of strategic industrial policies has begun. In 2026, we can expect the Western world to implement similar state-backed projects for lithium, cobalt, and rare earth elements. Breaking through $60 is not an end, but the beginning of silver's journey to reach its true industrial value. In the 2030s, in a world where billions of robots and terawatts of solar energy capacity are being built, silver trading at triple-digit prices appears not as a speculative forecast, but as an inevitable consequence of supply-demand mathematics and the structural fragility of byproduct economics. 2026 will be a year requiring careful monitoring, not just of price charts, but of supply chain maps, geopolitical alliances, and technological transformation. Commodity markets are set to become the hottest front in the global power struggle. I've been delighted to share this analysis with you. Thank you for watching.